Good evening and welcome to the CattleFax Trends Plus Cow-Calf webinar. As we get everything spooled up in here, I'd like to ask everyone that's attending the webinar to please click on the raise hand button over to the right so that we can confirm that you're able to see the CattleFax introduction screen as well as hear the audio. There we go. We got some hands jumping up, so it looks like we're good to go from a technology perspective. Thank you very much. First off, I'd like to thank everyone for attending the webinar this evening, and I'd also like to thank Alanco for sponsoring tonight's webinar. My name is Chad Spearman. I'm a market analyst with CattleFax. Tonight we're going to go start off with expectations for the grain and forage markets. We're also going to take a look at the key drivers for the feeder cattle, calf, and cull cow markets. And then we're going to finish up looking at the economics of cow herd expansion as we go through the balance of 2014 into 2015. So first off, let's start taking a look here at corn prices. Number one, we've had some significant volatility here in recent years in corn prices. But let's take a look at what we've seen here just year to date. We've seen corn prices rally in here early into a May high, and recently we've had a sharp decline, roughly 70 cents per bushel just over the past 30 days. So bottom line from a corn price standpoint is the long-term lower trend is still in place since the highs of August 2012. And given this breakdown in here that we've had over the last 30 days, the market is poised to test support near the $4.10 to $4.15 per bushel range, which was the lows from earlier this year back in January. Now first off, we got to consider the old crop situation for corn. That's the 2013 market year, which will end in August. As we saw prices dive sharply lower from the fall of 2013 through January, it reignited demand for U.S. corn, especially the export market. In over a 6-month period, we saw the export market, the demand picked up substantially. We saw expectations for exports rise from around 1.4 billion bushels up to the current estimate around 1.9 billion bushels. Significant demand increase as a result of those prices that pushed down close to that $4 mark early this year. At the same time, we've seen feed residual expectations remain flat since January, and corn used for ethanol estimates remain flat since January as well. Now, as we transition in from the old crop marketing year to the new crop marketing year, one of the key things we want to note in here is stocks to use levels, which are, number one, what we use to tie fundamentals back to prices. We want to note a couple of things. Number one, stocks to use levels are currently projected near 13% for the current marketing year, as you can see at the far right of the table. So close to 13% stocks to use levels will continue to weigh on prices if we actually realize those. But if we look at what's happened over the past 4 years, if you go back to the months of May and June, you can see that we started off with stocks to use levels on top of 13% in terms of expectations, but we end up either having production losses or significant demand increases that drew stocks to use levels lower and supported higher prices. But as we look at the current expectations, given the solid moisture we've had across the Corn Belt, expectations are for corn production to push upwards of 14 billion bushels or more for this marketing year of 2014 and 15. So you can note on this chart that production for the second year in a row is expected to exceed total usage for the year. In other words, building stocks levels relative to the prior year. You can see going back from 2008 through 2012, we went through a very consistent string where production levels were smaller than total usage, and therefore we drew ending stocks lower and lower, and that's what supported record high prices as we move through there. So expectations as we go forward is for corn prices to remain under pressure and lower trending here for the balance of 2014. Also, with the increase or the improved moisture situation, when we take a look at hay production and hay prices, it also suggests in here that production is going to be larger in 2014 compared to a year ago. What we have had is improved moisture situation. Expectations are for harvested acres, total harvested hay acres, to be about flat compared to a year ago. However, given the moisture situation, yields are most likely going to increase, providing an increase in production. Now, as we look at hay prices have fallen below year-ago levels here in recent months across most regions of the United States. However, it is worth noting that in the western region, hay prices still remain quite high, and actually above year-ago prices in many instances. But for the year, expectations are for cheaper feeds as well as improved profitability for the cow-calf sector as a result of cheaper feed grains and hay. Now with that, I would like to introduce Mike Murphy, who's going to share our outlook on the feeder cattle, calf, and cull cow markets.
Thanks, Chad. Well, obviously we've had a big run in this feeder cattle market here so far in 2014 as we start to think forward, looking into the remainder of the year and really trying to focus in on the value of calves and yearlings for the second half of 14. There's a couple of key factors that we need to kind of identify relative to influencing the market. And as you start to kind of look at things here relative to the first one, heifer retention, certainly over the course of the last 30 days in many of the bigger cow-calf regions, we've seen some improved moisture. And that could be something that could lead to a few more heifers being retained back into the herd. Most of that we believe will take place on the cow-calf sector, but there might even be a few heifers that were destined to be feeder heifers this summer that could in fact go ahead and have a bull turned out with them. From a bigger picture perspective, as we think about this relative to the market, our per capita supplies as we look at 2014 and 15 are going to be down in both years when you make a year-to-year comparison. That could be very well magnified to even a bigger decline in 2015 if we keep enough heifers back. The key here is that as you retain heifers from this spring's calf crop, clearly there's going to be less of them to offer on the market here this fall, and that would be a direct impact on the calf market. When we start looking at margins in terms of the spot and the forward market, and specifically from a cattle feeder's perspective, currently the cattle feeding margins in the spot market are very positive. Most of the cattle being marketed at this point in time are making well on top of $100 per head. As we look into the fall, it would appear that those margins will decline significantly and likely spend some time in the negative territory. But between now and that period, the cattle feeder is going to continue to be aggressive in buying feeder cattle and calves because of that positive feeding margin. And then that takes us into the capacity situation. We continue to have an excess feedlot capacity relative to our available feeder cattle and calf supply. And that's going to create an environment that favors those selling feeder cattle and calves as the feed yards need to kind of continue to maintain some sort of capacity from an operations perspective. Furthermore, if this El Nino event does develop and we get some more timely moisture going through the third quarter in the winter grazing region, specifically the wheat belt, you're going to have competition for calves to turn out onto wheat as well. So all these factors are very critical in terms of the impact that we have on the market as we look forward here over the course of the next several months in terms of price outlook. And just to start with, when you think about that per capita net beef supply, again, drops another 2 pounds next year, which is a real huge impact because that's going to have a bigger driver in terms of the value of fed cattle and the prices of fed cattle as we look into 2015. And that cattle feeding sector is certainly going to go out there and bid up on these cattle in anticipation of the smaller supply for fed cattle equaling higher prices. So as we start to kind of dial it in and just looking at the seasonality of the market, first of all here from a 550-pound steer price, the market has been seasonal through the first 4 or 5 months of the year in the sense that it's been going up. Typically when we hit that peak green grass demand, is after that's over, you start to see the market soften going into the summer time frame. This is a type of market that very well could sustain these price levels that you see there as you look at that right axis of roughly 230, 235. That's a U.S. average price when we're looking at that. We could sustain in some sort of a level close to that as you go through the second half of the year. There's going to be some spots clearly along the way that the market will have some pullbacks. There'll be some sort of a disruption, whether it's the Fed market or maybe corn market. But I think as a practical range, we can feel very confident that the market could trade between, say, a 225, 235 range. For it to exceed those levels, then the demand would have to be a little bit greater than what we would suggest today, and that would be related back to if the Fed market's trading in the low 150s sometime later in the summer or the fall, and you've got deferred live cattle of 2015 on the April and the Junes trading somewhere in the low to mid 150s, or if corn was to get cheaper than what the outlook that Chad had laid out, and say we took corn back to $3.50 a bushel through the Midwest region, those are the types of variables that could drive this calf market higher. But right now we believe it's more of a range-bound affair as we look at the spot calf market, and that's what this is measuring when we look at this data. As we look at it from a feeder cattle perspective, again, this is measuring the spot feeder cattle market, and as you can see on a U.S. average, we're trading in the upper 190s. We feel like as we look in towards this third quarter time frame, we'll spend a lot of time somewhere in this upper 90s into 205, 208 range. And as we look at some of the data here from a price matrix in just a couple of minutes, you'll be able to see the influence that corn and the deferred live cattle will have on this feeder cattle market. What we want to be able to do is if for those who are following some of the data and information that we have been providing to you since our last trends webinar back in January, and one of the key things that we certainly highlighted was the monitoring the deferred live cattle trend in the market sector. And you can see as you look at the August feeder cattle futures and the December live cattle futures, they've had a 97% correlation between the two of them as you look at that data since the 1st of January when they started to kind of be measured at the same time. The importance of this is that the driving force behind feeder cattle is associated with those deferred live cattle. And if there's one thing that we can stress, not only as we look at this year, but going forward over the course of the next couple of years, if you're in that stocker business looking to sell feeder cattle, whether it's a summer grazing program or a winter grazing program, you want to be able to identify what's going on in that deferred live cattle market, because that's the driving force in terms of the value of what you're going to receive ultimately for those feeder cattle. So as you look at this chart, certainly as we start to look at December live cattle, and they've gone from the low 130s to sitting in here in the upper 140s, and you correlate that back to the feeder cattle market, it's been worth about a $30 to $35 hundredweight increase. So please keep this in mind as you read through the information in the updates. We put a lot of energy in terms of analyzing this type of data and ultimately trying to correlate this back to you as producers to help you make the right decisions. we know when there's a large margin to be captured, there's going to be a tendency to go out there and try to capture that market. But we want to be able to step back and make sure that we're letting the data drive our marketing decisions. And in this instance, as the deferred live cattle have gone up, it's been a direct correlation back to feeder cattle. So this will be something that's real critical for all of you as you look forward over the course of the next couple of years to zero in on in terms of making these marketing decisions. Now, as we come back into more of the spot market, as we think about the third quarter and into the early fourth quarter period, and we're trying to identify the value of feeder cattle. And what I would just say is you start to kind of look at things in here, we've got some levels in here identified in terms of that left axis, that live cattle futures price. And, right currently, we've got those deferred live cattle trading somewhere in that upper 40s area for the most part. When you correlate that back to corn being worth about $4.50 a bushel, it would suggest that feeder cattle would be trading somewhere in this upper 190s area for the most part. And if we went through that math fully in terms of a break even, what you would find is that actually those cattle would, if we're buying them at 192 with 450 corn delivered to the bunk, it's about a 145 break even. Now, obviously, in the current environment that we are today, we know that corn basis south is a lot higher in that Kansas, Texas region. So they're buying corn on top of $5 a bushel. But when you get into eastern Nebraska, eastern South Dakota, the Midwest area, they're buying corn 30, 40 cents below where the futures are trading. So it still fits pretty well when you look at this relationship in terms of this matrix. So currently the market is fitting pretty well. We're trading feeder cattle in that upper 90s. We're buying break-evens that would be closer to that 150 area, maybe a pinch higher depending on where your specifically location is. But when we start to look at this market and looking forward into this third quarter or early fourth quarter, we could very well have feeder cattle trading somewhere up towards 207, 209 into that range if we assume we have those deferred futures, which at that point we would be zeroing in on the February, and even if we get into early October, the April live cattle futures of 2015, if they're trading back into these areas here, this as in the 155, the 209 is where you would see the market trade to. So when you start to have this perspective, certainly there's some upside potential to the market, but it may not be as significant from current levels unless we get a lot more impulsive with this fed cattle market. Now, as we start to look at things in here relative to a question that we find a lot, which is how should we market our calves? Should we be on the video? Should we wait till later in the summer? What's the best marketing option? And what we're trying to illustrate with this data as we go back and look at the last handful of years, when you're looking at that left axis, what we were measuring is what the cattle are trading for during the June videos, the July video, the August videos, and the September videos, and then ultimately what our cash price is during the months of October and November. And so the easy one to identify as we think about the market was last year, 2013. The June videos, those calves that were contracted on the video or sold in the video were trading at about a $16 a hundredweight discount compared to where they would have been if you would have marketed them in the spot market during October and November. And I think that's pretty straightforward. If we think back to a year ago, we were still dealing with, $6 plus corn, and the fact that the cattle feeder had just come through a real significant equity drain through the first half of 2013. There was a lot of negative variables that were developing in the market sector. And then you can see how it stacks relative to these other years. I would tell you today, as we look at the June videos, and obviously we just finished one up in the last couple of days, as we look forward, we don't see a significant deviation in terms of what those calves will probably bring during that October-November delivery. If we had to lean one way, it might be where it's maybe just a pinch softer just based on that seasonal, but it's going to be real range bound, as I alluded to earlier. So it would look similar to maybe like that 2009, which is that blue line. So I think that the focus is today, if you've had a marketing pattern that you've been comfortable with over time, and that pattern is that we sell on the July video, or we try to contract our cattle in the July period, I think you stay with that process. It's likely treated you pretty well over time, and in this instance, there's still going to be plenty of buyers relative to the market. So I would continue to stay with that same marketing program at this point in time. As we think about it from a yearling perspective, and really what this is measuring, again, we're looking at the videos for each of those respective months on the bottom axis in terms of the July to September delivery. And same situation, you look at 2013, obviously we know that the feeder cattle market was essentially bottoming, not only in the spot, but the forward contract there in June of 2013, and went higher all the way through the fall as corn prices went ahead and declined. I would tell you again, in this environment, we're likely going to be in more of a range-bound affair. A lot of these yearlings trading somewhere in this kind of $195 to $205, $2 to $210 range, basis an 8-weight through the Central Plains area. I think that's still the basis of where we're going to spend a lot of time, and so there's not a huge advantage being on the video or trying to wait for a later market, if you will. Again, go back to the matrix that we would have shared with you a few slides ago in terms of really drilling down in terms of those market opportunities and what we see there. The final thing that we want to share with you is looking at the utility cow price. As you go through and you look at this data here, it's been very seasonal so far in 2014. First of all, we would suggest that it will carry a seasonal pattern going into the fall, but we're not going to decline near as much as what the seasonal would suggest for it. But what I would tell you is as you go through this third quarter window and you start looking at some of those opportunities out there, when you see buying for the Labor Day window, that time frame, and that perks up the utility cow market, if you have an open cow out there, or a cow that had lost its calf and you just don't think she's bred back or is going to breed back, we would encourage you to try to capture that cow and get her to the barn. Now, I know that doesn't fit for a lot of operations. If you're running in some of the western country, you're out up on cow-calf permits, you don't have that ability to go capture those cows. But for those operations that might be a little bit more confined in the sense that you're not spread out over several thousand acres, this is certainly something that we want to try to take advantage of. She's going to be well conditioned. Get her to the market as quickly as you can. The other thing that I would say, though, is that don't fade this seasonal looking into 2015. So if you have the resources, if you've got a little bit of extra forage, a little bit of extra hay, we would encourage you to carry those cows from the fall period into 2015. We need to be looking that far out in front in terms of making these decisions. The only caution that I would throw out there for you is monitor Dr. Douglas and what he suggests relative to the CattleFax update on the development of El Nino, because El Nino can develop into a little bit harsher winter, and so you may not gain as much weight on those cows as you carry them into the winter time frame. But this seasonal is going to work again next year. So as you start to plan forward, please acknowledge those opportunities in terms of trying to increase your returns relative to the market. So I appreciate your time. I'm going to turn it over to Lance Zimmerman, and he's going to go through looking at our opportunities in terms of purchasing bred females, and then we'll have Doug Hustetler with Elanco, who we appreciate their sponsor, come in and talk a little bit about some of the products that they have available as well. So thank you for your time.
Great, thank you, Mike. Just another housekeeping item that I'll put to your attention right now is I think some of you have already noticed the question window in your right-hand user panel. Feel free to be typing us questions as they come to mind. We'll collect all those questions and at the end of the session address all those to the best of our ability as time allows. And so please feel free to put those there and we'll get to them towards the end. As we talk about the potential for cow herd expansion and what it means to your own operations and the beef industry in the U.S. in general, I think one of the concerns that we hear in the countryside is, we're enjoying record high profitability right now. Why would we want to overdo this expansion mentality, oversupply the market, and see prices drop? And a lot of that discussion hinges off of the cow cycle. And you can see here in the early 80s as well as the mid-1990s, that was the typical cow cycle through that period. We'd see high prices occur as supplies dwindled off. We'd be motivated to expand herds from a financial standpoint. We'd build up those herds. The higher supplies would bring lower prices to the market, and we'd go through a contractionary phase again. The thing that's different about this potential expansion cycle, if we get to a full-fledged expansion in 2015, is that we got a lot of factors that, in our opinion, are going to dwarf the ability for a very aggressive expansion. And I think the numbers here really illustrate that quite well. From 2012 to 2014, so really 2 turns of the calendar, you sit back and you see us lose roughly 1 million head as we go from 30 million cows to 29 million cows. In those 2 years it took us to lose them, based on our estimates and our forecasts and models, from an aggressive standpoint, it's really difficult to see us adding back that 1 million head in a period that's sooner than 5 years. You think about the average age of the cow-calf producer, the capital investment that it's going to take to rebuild that herd, and just the general lack of momentum that's there from producers that have been psychologically pretty beat up from years of sustained drought. Really, for most of this century, we've had some major cow-calf producing region of the United States under drought pressure. And so because of those factors, we feel that the expansion, it's going to occur if we have the right weather environment to facilitate that, as Mike and Chad have talked about with both the expansion mentality and the availability of hay and forage. But it's going to be much more slow and much more methodical than past expansions have been. And so with that in mind, we're not going to see a very large, dramatic increase any particular year over this expansion period of larger calf numbers. It's going to be a very methodical, slow, steady expansion. And so I think because of that, producers can take heart that these price projections that we're throwing out here are going to sustain themselves over the longer haul, that we're going to be in a situation where our demand levels and the year-over-year increases that we've really seen each year coming out of the recession are going to be able to help support this expansion as we build back in our numbers. And so the next natural question that a lot of producers have is, where's the expansion going to occur? And so here you see all the state level information that we have in terms of states where cow-calf inventories are accumulated. And you can see here since 2012, that same 1 million head loss over that 2-year period, where the bulk of the cows were lost or gained. And so if you take the group of states off to the far right, those were states that had growing herd numbers over those 2-year period, about 242,000 head. And let's just consider that a wash by crossing out the 258,000 head that were lost by this group of about 20 states over here, 20 to 30 states. And so then what you're left with here is fewer than 10 states where you really see a huge opportunity for big cow herd number change. And you can see Texas obviously is the giant in the room with nearly 700,000 head lost over that 2-year period. It gets well over 1 million head lost if you take this number back to 2010. Nebraska, Tennessee, all the way through basically the Central Plains and Southeast really cover the majority of the states that were affected. And so as you think about where is the potential for a very robust expansion, it's in those states right there, which every one of those states is in the top 15 in total cow numbers from a state-by-state perspective. And overall, we're talking about 42% of the U.S. cow herd. And so as we look to this, obviously Texas is the given, but there's a number of other very critical, very big players from a statewide inventory perspective. They're going to be playing and having a hand in this expansion story as it shapes up over the next 5 years. As you start thinking then, the question becomes price. And obviously with record high calf prices, record high beef prices, and everything in between, we're sitting in a situation where the bred cow market, whether it's bred cows, bred heifers, or pairs, it's not going to be a market that's cheap. And so as you look at this, and if you had asked us even just 2-3 weeks ago, we probably would have talked about this 2014 shaping up to be a very, very seasonal year. The seasonal index factor here, would suggest that it would break down, into the $1,600 range roughly, find some support, and then rally back up higher. Now that we've started to see a little bit of moisture in some areas that were very concerning to us, namely the Texas Panhandle all the way up through Kansas and the Nebraska Sandhills, this price is likely going to find quite a bit of support, again, on a U.S. average basis. So knowing that regions are going to have different bidding structures, and obviously higher quality animals will have higher prices bid into them, but overall on average, this price is probably going to find quite a bit of support where they traded in May, right there around $1,680 a head. And so going forward, keeping that in mind, that has the potential to be a floor that we're going to work higher to as we bring those cows in from pasture and start preparing them for the winter calving season. And so as we think about that, I think the logical question is that reasonable? Is a $1,680 cow too cheap in the marketplace today? Is a $2,000 cow too expensive? Because let's be honest, a lot of us haven't had an opportunity to think about what is the reasonable price for a bred female, especially in light of record high calf prices. And so let's take a minute and think about this in terms of a market that has a good test to it, that every one of us are participating in on an annual basis, and that's that 550-pound calf price, calf market. And what you can see is there kind of an old rule of thumb has always been that it should take about 2 calf crops to pay for a cow. And so using that mentality, that's what this graph is trying to achieve. Essentially, on a per head basis, how many calves is it going to take to pay for that bred cow? And what you can see is the long-term average over 25 years is right at 1.5. So 1.5 calf crops basically to get that cow paid for. And you can see that during expansion years or even just stabilization years as you reach back to the early 2000s, that number creeps up higher than that 1.5 to a high of, let's just call it 1.65. During years of more of a contractionary phase or a phase where we're just not interested in buying bred cows, that number can dip as low as 1.4 basically. And so let's use that as our benchmark as we think about the next 2 years and just what it could potentially take to purchase a bred cow. And so what you see here is, let's just walk through some of this math. And here's the 550-pound calf price. We'll start on the left and we'll work our way to the right. And you heard Mike talk about a practical range for this year in that 220 to 230 range. To get a perspective of how robust that rally is during this year, that basically represents a 30 to 40% increase over the previous year if we average that for the year. If you think about that, that suggests that as we look at this year, and let's assume that we just are kind of at that average ratio of a 1.5 for this year, more just kind of a barely stable to hinting at expansion rate. That suggests we're sitting here for just the average quality U.S. average cow somewhere between $1,800 and $1,900. Obviously, some of those critical expansion areas in Texas, all the way through Kansas, out west, or east, I should say, to Georgia, obviously a little bit more expensive. The better quality genetics, again, be beyond this $1,800 to $1,900 range. But then let's say next year we don't quite add near as much to the calf market. Let's say again we're in this situation where for an annual average we're more in the 230s instead of kind of closer to the 220s, which is where we could average by the end of this year. That might only represent a 6% increase over what we're currently going to see for the year this year. Play that out, and you're talking about a scenario where you're right around $2,100 for an average cow. And so what might seem as an asinine amount to sit here and be paying $2,100 for a bred cow actually turns out to be, historically anyway, relative to the calf prices we're receiving, just an average price. And obviously cheaper quality, maybe smaller runs of cows, areas where, in the northern plains where we've seen a fair bit of expansion off and on over the last few years, might be able to get them cheaper than that. But by and large, a lot of the country will be staring at prices, if they're trying to expand in an area that's went through a lot of contraction, levels that could very well be justified well over $2,100 a head. And so we need to keep that in mind and keep that in perspective, that just like we've had to change our framework and the paradigm that we operate under when it comes to selling calves and what our expectation is for those sale prices, we got to change the perspective of exactly what we think a bred cow is worth and what the justified expense is. And that's not an easy pill to swallow, and you're talking about adding in, potentially hundreds of head back into an operation. But it's a reality of the market environment that we're in today. And so obviously we're doing these webinars because of this graph here. We're trying to help the cow-calf producer become a high-return producer. The yellow bars are the average U.S. cow-calf producer's profit or loss in a particular year, just based on cash costs. And you can see that the long-term average is that these cow-calf producers are clearly profitable. But there's a big difference between the high-return and low-return producer. And there's very different characteristics between those two groups, that top 25% of cow-calf producers and that bottom 25%. One of the biggest things year after year that you hear about the high-return producer is that they're almost always the low-cost producer as well. Not necessarily that they're cutting unnecessary costs or cutting costs that might be beneficial to their bottom line if they invested in them otherwise, but those producers that trim the fat, those producers that are very value conscious, year in and year out, consistently find themselves in that high return producer group. They're also the producers that, as they make investments into their herd, measure them against the potential returns. And I mentioned this in this section of our webinar because I think it bears keeping in mind as we look at what type of candidates we want to bring in to our cow herd, whether that's breeding females or even bulls. And so we'll talk about that here just a little bit now. And what's great is cow-calf producers, by and large, you have some options. You can buy cows, you can buy pairs, or you can buy heifers. And since we talked about the bred cow market a little bit and what some of those price expectations were for probably this year and next year, I thought we'd share these pair and heifer information relative to that base price being the bred cow price in the U.S. And so let's focus on this graph on the left first. And you can see here this is the U.S. pair price as a percentage of bred cow price. And I just did a simple monthly average of that ratio as you work through these periods. And what you can see is over the course of time, over the last 15 years, you're in a situation where on average pairs are bringing between 14.5% and 15% higher than the price of a bred cow. There's a pretty decent seasonal component to that where that premium is smaller as you work into January through March, but again, the market and the available supply for pairs is also at its tightest probably at that time, and it's the biggest challenge to find some of those animals as calving kicks in. Obviously, the market opportunity for those animals kicks in, and similar to that yearling market, green grass fever definitely has a role in pushing that premium higher. And so there's definitely a seasonal component to where you might be able to see that premium less than that long-term average. But let's think about this a little bit. If we have a 14, or let's just call it a 15% premium for pairs, 15% of $1,800, we'll just call the bred cow price $1,800, is roughly about $285. Let's just put a range around that, and let's say that plus or minus $50, we're talking about somewhere between $230 and $300 essentially extra to buy that pair versus a bred cow alone. That calf is likely going to bring around $1,200 to $1,300 at sale time based on some of Mike's estimates. And so that initial extra $250, maybe $300 is going to return you an additional $1,000 at sale time that you don't have to wait for, unlike the bred cow. It also doesn't involve the gamble of if that cow loses her calf in a tough calving season and a bunch of other factors that need to be considered there. And so in some ways, that opportunity to buy pairs might be a no-brainer for some of you. Others of you might see it as a challenge. And so that's up to each individual operation, obviously, to make those decisions on their own. Conversely, the bred heifer market. And again, you can see as you look at that right graph, the bred heifer price as a percent of the bred cow price, again, has a very strong seasonal, but the highs and lows aren't as extreme. Notice the range here. We got 98% to 102. Not a very huge range as we look at this, especially over the first 3 quarters of a year. Really, you only see these heifers actually coming at a discount to cows as obviously you work into this 4th quarter period. And so as you're thinking about and assessing your situation coming into weaning time, maybe there's an opportunity for you to come out here and buy some bred heifers at a discount relative to this bred cow market. Now what you need to ask yourself is, what does this equate to? And again, using that $1,800 cow as our base price, seeing a 1.5% discount, you're really only talking about a $30 to $50 a head savings. What you have to ask yourself is that discount worth it to add that younger female into your operation? Obviously, bred females are known for attitude issues, for potential calving issues if the producer didn't use the right type of bull on them, and in general, more headaches. And as we think about an aging producer demographic, that might bid more of a premium back into this bred cow market and cause those heifers to be even further discounted as we work into those seasonal highs later in this calendar year. So again, another factor to keep in mind as you're trying to make some decisions. The obvious advantage for bred heifers is you're getting younger animals. They're going to have a longer serviceable life by at least a year, maybe more if there's some 3 or 4-year-olds out in the marketplace. You're also, by most accounts, getting more youthful genetics and hopefully better genetics if the seed stock producers are doing their job right. The last thing to think about as we talk about bred cows, let's talk about the other side of the equation and talk about our bulls. And I think it's important for us to not forget what the bulls bring to the equation in terms of the productivity of our operations. And if you talk to any of our analysts here in the office, we'd suggest that there's really 2 great opportunities to sit back and evaluate your bull battery. First is weaning, as you're seeing those calves and the progeny of some of your older bulls on your operation get weighed up, get ready for sale time in a lot of instances, or get passed along to the next phase of production. The second time is at calving season, when really if it's a younger bull, their first progeny are hitting the ground. And a thought to keep in mind is that aggressive culling in this area of the business might offer you higher returns. And I want you to think about it in 2 perspectives. Every investment you make on your operation has 2 costs to it. The first one's sunk cost. The other one is opportunity costs. Sunk costs reflect the costs that have already been spent on an investment. Opportunity costs represent those costs that are going to build into the future. So as you think about it from a breeding female or breeding bull standpoint, culling an underperforming bull now means you're going to likely lose on a per head basis a larger amount of sunk costs than culling one underperforming cow. That bull cost you more on a per head basis in all likelihood than the cow did. But the challenge is the opportunity cost of keeping an underperforming bull can be much higher than keeping one underperforming cow around one extra season. And just think about it from this perspective. Running a bull on 30 cows, and maybe those calves that you had seen the previous calf crop were 15 pounds less in weaning weight than your other bull battery. looking at that from that perspective, on just a $220 100-weight calf market is a cost of $990 to you. And so with that thought in mind, it makes sense to be aggressive in buying a larger number of bulls and culling more aggressively at the end of the season to make sure that the bull battery you have left going into each new breeding season is progressively that much better than the one that you left behind the previous season. And it's a given that bull prices are going to go up with bred female prices. We know that's going to happen. As we have more cows, there's going to be a need for more bulls. But there's probably some opportunities out there, especially if you want to adopt this framework of buying extra bulls and culling more aggressively on the back end. There's some opportunities to mitigate some of that cost. And one of those opportunities might be, just like you have multiple opportunities to buy bred females that are heifers, pairs, or cows, buying 18-month-old bulls instead of 2-year-old bulls. Now, obviously, that 18-month bull is going to be cheaper today. It'll give you that opportunity to introduce some newer genetics, hopefully that much earlier, but you're not going to be able to run them on as many cows as the mature bull. And so this is obviously a consideration to keep in mind, but maybe if every single year you find yourself in the market for 3 2-year-old bulls that are female ready, maybe instead you buy 2 2-year-old bulls and 2 18-month-old bulls. Or whatever the situation is, find that balance that works for your operation to make sure that your bulls are covering all the females that you have on your operation. But at the same time, you're not working yourself into a pinch on the back end at the end of every season, needing to find a large number of bulls to bring back into the operation. And so those are all things that you can think about from an opportunity standpoint of mitigating some cost, but also adding some future value to the operation as we go forward. The other side of the equation, as Mike talked about video sales towards the end of his presentation, is something we talk about at CattleFax called the stair steps to profitability. And what this is if we start at the bottom with the orange line, average cattle are just commodity cattle. Those are that commodity price. When we talk about the average female price, the average calf price, those are just typical run-of-the-mill everyday cattle. We know that there's just as many cattle that are out there that we could call undermanaged. Obviously, if average is average, there's something going on to cause cattle to be less than average, and those are those cattle that they went to market and they weren't dehorned, they weren't castrated, they were still balling calves. And as we look at this marketplace, especially when we're sitting here at a calf price that's $1,200 to $1,300 a head, we're sitting in a situation where producers are likely paying the upper end of these premium ranges for these different components of management, whether that's weaning alone at just $4 to $5 a hundredweight, and I would argue likely higher than that as we look at this year's prices and what those components are going to bring, certified vaccination programs and coordinated health among your herd, and advertising that component and getting the verification of that from your veterinarians. And then this third one here is really where the genetics kick in. The natural claims obviously is a production-oriented one, but a lot of your premium programs today, feedlots, stocker operators, and backgrounders are looking at the type of genetics used in these programs to understand what potential they have to hit these premium branded programs, whether that's certified Angus beef, certified Hereford beef, sterling silver. And so as you're considering these purchases, whether it's a bull purchase, bred heifer purchase, pair purchase, be asking questions about the genetics in these animals, not just breed, not just hide color, but be asking questions about EPDs, asking about progeny performance, asking about how those producers' calves sell at the marketplace, if they're commanding an average price or a premium price. Because really, in order to hit this $8 a hundredweight target or even more aggressive than that, you really need to have the genetic package there, the performance and the grade and the health really that comes from better genetics to hit these premium targets that are in this upper end of this range and beyond. Then there's agent source verified, which still carries a nominal value to the marketplace, but not necessarily related to market access to export markets. And then, of course, that aspect of performance history. And I think as going forward, as there's opportunities that present themselves for retained ownership, you're going to see more premiums offered in that marketplace as producers above the cow-calf segment look for more known performance as they look to purchasing cattle to feed out. And so with that, I want to transition, get back to the right slide here, transition it over to Dr. Doug Huffstetler and let him talk a little bit about some of the things that they're doing at Elanco. And I'd also like to remind you all that as you have questions, feel free to type them in the question bar for us, and we'll address those all as soon as Dr. Huffstetler is done. But he is the beef technical consultant for Elanco out of Guthrie, Oklahoma. So Dr. Huffstetler, are you available?
Yes, thank you, Lance. It's a pleasure to be with all of you, and it's an honor for Elanco to partner with CattleFax on educational efforts such as these webinars. You can go to that next slide, Lance. What I'd like to talk to you today is we'll tie into the value message that CattleFax has been driving today. We'll consider some hay price discussions, but also just the value that some technologies that Elanco can provide to you as a producer. And one of those that is often overlooked by the cow-calf sector of the market is the fact that you can use Rumensin in the cow herd. Many of you may be familiar with Rumensin's application in the feedlot sector if you retain ownership by increasing feed efficiency in the feedlots, or if you used Rumensin in your stocker programs or replacement heifer programs to improve average daily gain. Most producers are familiar with those applications of Rumensin, but many are not familiar that Rumensin is the only approved feed additive to improve feed efficiency in the cow herd, and that goes to the value message that CattleFax has been driving today, and some savings that we can provide when you use Rumensin in your feed costs, and becoming one of those value-conscious producers getting into that high-value sector of the production of beef cattle. And so I'd like to show you some data here with respect to the cow herd and what Rumensin can offer. And one of those things is that the dose is 50 to 200 milligrams across that top line. But what we did with Rumensin is you can feed beef cows, and sometimes they will consume 5 to 10% less forage, or you can feed them less feed if you have them in a dry lot, depending on what part of the country that you're in and how you handle your cows in the wintertime. And so we've had a lot of people during the drought, the recent droughts, feeding their cows in dry lots. And so this is a way that you can take advantage of Rumensin, reduce the need for forage by 5 to 10%, and capture that cost savings because of what Rumensin can do. And so we can, if you go down there, you can look that these cattle were fed 5% less feed in the 50 milligram dose, or 10% less feed if we fed them the 200 milligram dose. And what we were able to do is maintain their body weight on 5 to 10% less feed. And so the first question that most cow-calf producers have, well, that's great, but what does that do to production? That's a great cost savings to me, but I make money off the calves that I get off the ground. And so those studies were also combined with reproductive safety studies to make sure that if a cow is consuming 5 to 10% less feed, that it's not impacting reproductive performance. And so those bottom two lines on this chart show that percent conception was not negatively impacted by even though these cows consumed less feed, forage and supplement together, and they were able to maintain their percent conception and even increase it. And then in another study where they just looked at either 0 or 200 milligrams, which that's the dose most cow-calf producers are targeting that are actually using the product. And in those cases, calving percentage was actually increased. And so the point being is that you don't have to worry about decreasing reproductive performance if you use Rumensin to save on feed cost or feed outlays for your cow herd. And we know that that's one of the biggest costs that you incur throughout the year. And so it's a way that you can take advantage of the technology that's been used in the feedlot industry for years and apply that into your cow herd. And if you go to the next slide, Lance, this shows the next one here. We use the OSU cow calculator, and many of the state extension offices would have their own version of something like this, but you can go on many of the state extension websites like OSU's and pull up their cow calculator, and you can look at as hay costs go up over time and supplement costs, because they generally track together. And this doesn't even go as high as those hay prices that the CattleFax members discussed earlier. But generally, for every $20 increase in hay price that we see due to whether that's drought or just increased input cost, we pick up around a $4 increase in the net value or net feed savings that Rumensin can provide to you as a cow-calf producer. And this was just during a 112-day supplementation period, which many of you would supplement protein during a 112, 120-day period of the season. And that's a convenient way, is to put the Rumensin in your protein supplement program and use that as your delivery mechanism for Rumensin. And so as we're trying to maybe move body condition scores from 4 to 5, if we've been in a drought situation and forage has been limited, we can take advantage of what Rumensin does. And if we expand this graph out to the hay prices that were mentioned earlier, that $150 to $170 hay price range that we've been working through as we're coming out of the drought, hopefully that will drift lower if the El Nino sets up. But as we look at those prices where they are now, right now that net value of Rumensin is around $30 to $35 per head savings per cow during a 112-day supplementation period. And just a rule of thumb to remember with Rumensin is it actually costs you approximately 2 cents per head per day to supplement a cow or a stocker calf or a replacement heifer with Rumensin at that 200 milligram dose that we tend to migrate towards, because that gives us the biggest improvement in efficiency. And so that's just something to consider as you're considering trying to improve the value of your operation, improve the efficiency of your operation. Consider some of these technologies like Rumensin that you can apply, and don't hesitate to contact your beef extension specialist. Many of them are well versed in the impact that Rumensin can have on your herd. And as well, you feel free to contact Elanco at any time. If you go to elanco.us, there's a rep finder on there for you, and you can type in your information. Someone will contact you, and they will get you in touch with an Elanco representative that can help you try to locate products in your area that would be a means for you to deliver Rumensin to your cow herd. And once again, thank you to CattleFax, and we just appreciate being able to partner with them. And that's all I had, Lance.
Thank you, Dr. Huffstedler. And I'll mention as well that for those of you attending the webinar, we will have a follow-up survey that'll go out tomorrow morning. It'll have a link for the archived presentation. That'll be in PDF form, as well as a video on YouTube for you to watch in case you didn't catch it all the first time we said it today. And it'll also have a survey link in there where there'll be an opportunity for you, if you do want contact from an Elanco rep, to put your name and email and phone number. It's optional to do so, but that opportunity does exist. So Dr. Huffstedler, I'd like to thank you for your comments today, and thank Elanco for the sponsorship. These webinars, obviously the technology and time invested in them has a cost to it, and your sponsorship certainly makes it possible for us to offer this for free to the industry as a service. So thank you. Well, what we'd like to do now, we got just a few minutes left, and I want to be very respectful of people's time. I did a little bit of the housekeeping there regarding the presentation and some of those questions that you all asked. One question that I'll address, and then I'll turn it over to Mike to address a couple, is somebody asked if consumer beef prices are likely to continue rising through the duration of 2014 and into 2015. I think you got to look at this from two components. Prices move based on either supply or demand. And we're in a situation going into 2015 that if we're in an expansion mode, heifers aren't going to be into beef production. They're going to be entering the cow herd. So supplies are likely going to be lower as we look into next year. That alone should have a positive influence on price. That then asks you, is the demand going to be available there for consumers to support that higher price based on a reduced supply? And right now, we've been in a situation really since the recession, so 5 years, where we've seen year-over-year increasing demand. And so I think you've got to operate with an assumption today that demand's going to be at least steady to higher. Now, does it play out that way? There's a lot of moving parts to consider. But our friends in the pork industry are facing tighter year-over-year supplies and likely to see that continue at least through part of 2015. Poultry is expanding, but they're struggling to steal that market share from a demand perspective away from beef. And so right now I think it is a safe assumption that we're going to see higher year-over-year prices throughout the rest of 2014 and at least through the first half of 2015, and then see how the economy and all those other factors play out. So, Mike?
There's several questions relative to feeder cattle basis, and I think the best thing is if you all could just send us an email, and we could kind of be more specific to your potential region in terms of the feeder cattle basis. There's also a question relative, will the steer heifer feeder spread narrow as we go in here in the course of the next 18 months as we train more heifers? And that answer is yes. That's something that will definitely take place as we have fewer and fewer cattle offered up from the heifer perspective, that you'll see those spreads narrow up going in here during this expansionary phase. So, and those questions that have come through that we didn't get answered, as you look at the screen right now, you see our emails. Please feel free to drop us an email and we'll respond back to you. We've gone really at our full 60 minutes, and we want to make sure that we don't overdo this. So those who are not a CattleFax member, please take the opportunity to become a member. You can see that you get the 2 years for the price of one, so we'd encourage you to become a member of CattleFax. We do have some educational seminars that we would encourage you to take a look at. If you have any of the questions to any of these seminars, please contact us, and we would be more than happy to go ahead and reach back out to you. Our next Trends Plus webinar right now is scheduled for September 17th. So we appreciate your time today. Again, thanks to Elanco for their sponsorship. It really makes this program go for us. And please email us with any of these questions that we didn't get answered, and have a great evening. Thank you.